if December comes flatline or negative, we're in a technical recession. 2 consecutive quarters of negative GDP growth is a technical recession.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined by David Warren. We're both level 2 mortgage agents, and we're back. We want to say thank you to you for listening. We also want to let you know if you ever have any questions about your mortgage, renewals, refinancing, purchasing, whatever you need that's related to mortgages, Dave and I are here. Our contact information is in the description. You can reach out to us anytime. We're always happy to chat. And a quick shout out to our amazing sponsors, Carte Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. If you go to easyneonsigns.ca and use the promo code TOREP, you can get 20% off each and every order. David, how are you doing? Welcome back. We missed you last week. People were asking.
They were asking?
What's happening?
I don't think anyone asked.
No one asked, no.
Doing well. I was down south in Mexico on our annual brokerage rewards trip. So it was a pretty good time. We had about 43 people out, agents, a few lenders came as well. It was a great time.
We had approximately 43
a little bit of fun, a
people.
little bit of work. Approximately.
Yeah.
Exactly.
Yeah.
Actually, 42 and an infant, which made up that 43. So that's why I say approximately.
That's great.
Infant is kind of in the number.
Yeah, it's tough coming back to this weather. We had, between that polar vortex you missed out on and the sub-zero temperatures we're fighting. Yesterday was better, though. We're getting there. We're almost spring. Mm-hmm. Spring has almost sprung. And you know what that means, Dave? That means hot rates, hot real estate market.
Wow. Oh, wow.
Job cuts. That's what it means. We actually, to start off, we have a few things we wanted to go over. The first of which is actually regarding the public service job cuts, federal public service job cuts. So we kind of touched on this prior to the elections. I know a hot topic for the elections was talk of these potential job cuts in Ottawa. Obviously, being in Ottawa, this directly impacts the housing market and our economy and so on. So recent reports actually have charts that kind of show exactly what sectors are going to be impacted by this. But the federal government is planning to implement significant reductions to the size of the public service as part of the efficiency and budget measures that were announced last year. So this report suggests that tens of thousands of positions could be cut over the next few years, specifically in the National Capital Region, which is here. These cuts are going to reshape local employment patterns, raising questions about where displaced workers will find new work and how this shift impacts services and the economy locally. So I'm just going to pull up the actual article here so we can show everyone.
And really, really in this, as Paul's bringing it up, we'd really like to hear from any of you listeners if you've, you yourself or any of your friends or colleagues have received notices yet. I know that I have a few people that I've spoken to that have already received notices or already been notified that they're likely to receive, kind of a buyout, if you will. So we're curious to hear, in the comments, any of you that maybe have been impacted or are likely to be impacted, and how kind of that's reverberating through your departments or through your life. So certainly reach out and kind of let us know, boots on the ground.
Yeah. So in looking at this chart, the WFA stands for workforce adjustment and CT stands for career transition. So here we go. This is kind of by department. So here we go. Number of employees to be reduced through the WFA and CT. So Health Canada, 1,056. They're kind of leading the charge. I won't go through all the numbers, but I'll go over the first few here. Employment and Social Development Canada, 931. StatsCan, 764. Public Service and Procurement Canada, 722. And Environment and Climate Change Canada, 565. So that's just kind of the top 5. Going further down here, it shows percentage of total positions set to be eliminated through the WFA. Public Safety Canada, 20% of all positions. Health Canada, 11.3. The Privy Council, 10.4. Stats Canada, 10.1%. Innovation, Science and Economic Development Canada, 9.1%. Agricultural and Agri-Food Canada, 9%. So it doesn't say exactly how many positions. Obviously it does up at the one right above, but percentage-wise, Public Safety Canada, 20%, that's, 1/5 of the workforce is a pretty large number of cuts. And this will be rolled out. I know they are saying this is going to be rolled out over the next coming years. A lot of these are kind of expiring contracts. They won't be renewing, but the numbers themselves, considering, again, the discussion during the election was that we could avoid some of these job cuts depending on who the leadership was. And it seems like now, obviously, these have probably even more cuts than were expected originally just because of the way that they've structured this. So this next one shows planned executive cuts by organization. So it shows total executive cuts and then executive cuts through career transition. So Employment and Social Development Canada, 98 executive cuts and 39 through career transition. Global Affairs, 60 and 60 through career transition. 68 for Public Services and Procurement Canada, 39 through career transition. And then lastly, Health Canada, 36 executive cuts and another 36 through career transition.
I think the most important is kind of the executive positions. When we kind of read it out, it doesn't seem like it's all that many in comparison to the other positions. But when they further break it down as a percentage, really, Public Safety Canada, it's 25% of their executive positions are being cut. Health Canada, 13.69%. Shared Services Canada, 13.43%. Crown Indigenous Relations, 12.6%. Environment and Climate Change Canada, 11.93%, and so on. So it's actually, because there's obviously not as many executive positions with these cuts, it is, really shrinking that branch as well, which is, when looking at the percentage, is an interesting one.
Yeah. And do you think, I mean, especially in Ottawa being such a government heavy town and city, called a town still because it's, much smaller than some of our other major urbans, but does the shrinking public service mean like the local economies are going to get hit harder just because they rely so much on those federal jobs? I know, for example, during the pandemic, we saw a lot of downtown businesses get hit really hard just because nobody was in the downtown core, right? So something like this with less people maybe working in those environments, like what impact does it have on the local economy here in Ottawa?
Well, there's certainly going to be an impact, and obviously an impact to these families. I think really kind of where it'll kind of roll out is over what period of time is this happening, and can the private sector in those types of areas that those people are being let go, are they later in their careers, which most of them are, and they're closer to retirement anyways, so it's just kind of that like early retirement and not needing to seek out job replacements. So I think the numbers on where that plays into, because I believe that they're going towards, first and foremost, those that are closest to retirement, and then, and kind of working backwards. So is it just early retirement, which isn't really necessarily impacting the local economy so much, so being that they're going to be full packaged out. They're going to receive their full pension. They would probably be, some of them only a few years out anyways, or a couple of years or whatever it may be. So, I don't think those are going to impact the economy so much. So, but then those that aren't as close to retirement looking for new positions, number one, over what period of time is this happening? Where can the private sector or other areas of government, municipal, provincial, that have job openings absorb those positions, and or private sector, again, same thing. And then how many of those though play the game of, when we've seen it in the past countless times that they then just ramp up the people consulting back to the government, which doesn't play into those employment numbers. And so is there going to be that game of like, full-time employment being like those people, those jobs being cut, but then they're consulting back at a higher rate of pay anyways while getting full pension? Like, is that going to happen? And we've seen that, over like through both the Conservative and Liberal parties, that those numbers kind of fluctuating because they don't play into the same employment figures, and it's a way they can kind of skirt those. So like there's still a few questions there, but regardless, any job loss, especially in the thousands to our economy, if it happens over a couple of years, is going to impact things regardless.
Yeah, and I wonder how many of those that they are cutting may already be those contractors that are just being, that have already technically retired and are now kind of doing these government jobs. Like, I wonder if those are being incorporated into this job cuts, as far as people just no longer getting those contract opportunities. And maybe the people that are being no longer renewed, let's say they're on they're in their mid or early 50s and they're on their, they've been there for 20 years or kind of on just a rolling annual contract. If that expires, that to me is a bit different than someone who, is in their early 70s, retired 10 years ago, and is just kind of doing these rolling contracts, already has their pension, kind of double dipping to a certain extent. we were talking about this too. There are other opportunities where people may have had, someone we know, not to obviously get into specifics, but they work for the government, but they have been on a sabbatical doing a different career, right? Kind of something that they were passionate about kind of during the pandemic. And now they have an opportunity where they can actually have kind of a slow exit from the government, kind of still benefit from the time they put in there, but they already have this other secondary career that they can kind of jump into. So I think we may see people take advantage of that as well, where maybe they had something that was, a side hustle or a side project that they've been working on that now they can kind of double down on. So we might see that private industry grow just because people have the ability to kind of put a bit more energy and a bit more effort into that side project.
Yeah, I mean, you and I both have, we have a number of friends that, being in Ottawa, that are public service employees, and that where they've taken, they've gone the self-employed route, and there's the ability within the federal government where you can take an unpaid sabbatical. You're not paying into your pension or anything like that unless you pay it back at a later time when you go back. But you could take a sabbatical unpaid, and we've had friends that and have friends that have done that, started their business self-employed, and then left the government and given notice that they're not going back. And I would imagine, to your point, through the pandemic there was a number of people that probably did that. We know of our friends, there's a number of them. Again, do those job numbers or job cuts, like, are those people already employed elsewhere anyways, and that they're so that job's already been absorbed back into the economy, from an impact perspective. So some of those, we probably, it's going to be hard for anyone to get those figures because it's going to be just like that headline number. But it will be interesting to see, like, whether we hear of kind of stories throughout the community of people just being cut with no other opportunity and just being kind of on the unemployment line on a job hunt. And I'm curious to, I'll be curious to see and hear whether that's the case in the coming period of time.
Next thing we wanted to touch on was the mortgage arrears. So we did touch on this about a month ago. And this was an article that was on Better Dwelling with regards to the mortgage arrears rate. So has hit a new 5-year high. So this says the share of mortgages that are at least 90 days past due has risen to its highest point in 5 years. So November data arrears clocked in at about 0.25%. So it's a small percentage, but significantly higher than recent record lows. Rising delinquency counts, now at their highest level since 2020 outside the pandemic, may signal underlying household financial stress. At the same time, the largest banks are holding fewer mortgages overall, which amplifies the impact of each delinquent account. So with rates now higher than kind of pre-pandemic, are we finally seeing the stress show up in the arrears? Like, we're seeing more listings, longer days on market, like higher arrears now. I mean, this seems like a bit of a result of everything that's happened over the last 5 years. But do you think, Dave, in your opinion, like, do you think this is going to continue trending in the direction it is? Or do you think we've now hit a point where people are able to get their finances back under control and we might see this reverse itself?
I mean, I think it's going to take some time for it to reverse and for people to get their finances back under control. Our unemployment rate is around, I think it's at 6.8%. So it's significantly higher than our counterparts in the US, which I think are 4.4, 4.5. And that's been rising. And I believe that the numbers are, I think they were out that it even rose or is expected to rise. And we'll get into it later on in this episode as well. But just where the overall broader economy is of household debt, unemployment, GDP per capita being negative, the economy as a whole being flatlined and negative. I don't foresee people kind of getting out of where they're at anytime soon. It's going to take some time. Obviously, rates being elevated impact that. And the unfortunate thing is that these individuals that have these 90-day past due mortgages, like 3 months behind, it's something where if you're at that point and you haven't been having a conversation with a professional yet, go speak to a mortgage broker, not the bank that your mortgage is with, because they're not going to be willing to help you, but look to options to move that mortgage, stretch out that amortization. Maybe if you're unemployed, or you're short savings or something, life event has happened where you're not able to make that mortgage payment in the here and now. Like, are there options to tap into equity in order to get you over that hump? Like, have those discussions. Don't wait for it to be 90 days past due, because what it's going to do is it's going to impact you on, not only your credit and your finances now, but it's going to impact you for a very long period of time. Because as soon as banks see those M2s, M3s, like mortgage arrears on your credit bureau, banks are not going to lend to you, unfortunately. And it's going to take a very long period of time for that to happen. You're going to be having to go to the alternative market, which means higher rates, higher down payment amounts, higher payments, and all of that for quite a period of time. So if you feel like you're getting up to that like period where you're kind of out of money, you don't think you're going to be able to make that next payment, that first pay, you're going to miss one payment even, like start having a conversation then. Don't wait until 90 days past due, 120 days past due, because you're really kind of getting into that foreclosure period, which is even worse.
Yeah, and I mean, you made a good point too up front. If let's say your mortgage payment's $2,500, if you're 3 months behind, typically people are paying their mortgage or their rent first. So if you're already $7,500 behind on that payment, like how likely is it that you're going to get back up to par in the next 12 to 24 months? Like it is going to be hard. So there has to be some form of restructuring or discussion had to see what other alternative options there are, because clearly something has changed, right, in your financial picture for that.
And
to
there's
happen.
likely credit card and lines of credit that are, well, are even further behind that, because to your point, people pay for their housing first, and then their like credit card or lines of credit interest payments to keep them up are always kind of secondary and third. Food and roof are kind of those first ones. So, if mortgage is behind, where are the others? And if it's a rental property that is behind, again, like, that individual was an investor, bought a rental property. Well, being that far behind, the likelihood of getting like even another mortgage again for a very long period of time in the A space is going to be very difficult to non-existent. So kind of keep your finger on the pulse of your finances, especially if you're going through tough times, and speak to a professional right away. It's not going to be your individual bank, because as soon as you missed any sort of payment with your individual bank, credit card, line of credit, especially mortgage payment, they're not going to help you. Their hands are tied. Their internal systems will not lend to you. And so just doesn't mean that all hope is lost. Just speak to a broker that can actually shop it elsewhere.
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker. Last but not least, David, Canadian GDP. The growth was 23% smaller than the Bank of Canada forecast. Canada's economy grew more slowly than the Bank of Canada forecast. Stats Canada shows a flat GDP, dragging the preliminary annual estimate for 2025 to around 1.3%, which is about 23% below their recent 1.7% forecast. Some sectors grew modestly, but goods output has weakened, raising questions about the Bank of Canada's models and assumptions. So I know you had some stuff to expand on here, Dave, but this shows half of the sector still saw growth. So this shows on the left side, obviously, a negative growth, on the right side, a positive growth, and then it shows all of the industries based on a percentage change. So worth looking. If you're listening to this, maybe go check out YouTube. I know we're very chart heavy on this episode, but visuals are always great. So this is just kind of a visual. And I know, Dave, you had a kind of a deeper dive into the GDP numbers. So did you want to touch on that?
Yeah, I mean, kind of to your point about the flat line in November of GDP growth, keep in mind that October was a negative 0.3% GDP. So really in the month of November, Canada ran an $8 billion deficit through the month of November alone and had a 0 month-over-month GDP growth, which is obviously we're spending $8 billion and getting nothing, no increase. That's not good. And a negative, and that negative figure in October. So Q3 was already negative GDP growth. Right now, for end of 2025 Q4, the December numbers haven't come out yet, but we had a negative growth in October, flatline in November. If December comes flatline or negative, we're in a technical recession. 2 consecutive quarters of negative GDP growth is a technical recession. So I'm not sure, and I can't think back to when the Bank of Canada or a central bank would increase rates in a recessionary environment. So that's something, it's not to say that they might not change course, but it's a pretty hard. It would be very hard for them to kind of go that route. And so it's something that's really interesting, something to follow is how much we're spending in the budget for what return in the economy. Like I said, I mean we're spending significant sums and we're not seeing any return. It'll be interesting to see if those Q4 numbers come or the December numbers come out and our Q4 numbers come negative, what the Bank of Canada kind of does as a go forward to kind of spur the economy in that realm. Really kind of in that the unemployment numbers are coming out this Friday. Canada's unemployment rate is forecasted to remain at 6.8%, and they're forecasting, Stats Canada's forecasting only 7,300 jobs created, whereas the U.S. their unemployment is targeted to remain the same at 4.4% and 70,000 jobs created. So we have a chart up on YouTube showing these charts, and as well kind of that comparison of seeing the quarterly growth and negative growth in kind of over the last quarters dating back to 2022, and how we kind of been moving along and what that forecast is, because Q4 is forecasting a negative as well as far as an overall. So we'll see what happens, and then what that further decision is from the banks and the Bank of Canada with regards to rate decision.
Yeah, I completely agree, and this is kind of the sentiment I think overall in our industry now is that definitely a lot more people asking about variable rates. I've had more variable rate conversations in the last month than I have in probably the last year, which is not a bad thing. Just kind of a shift in the overall understanding and interest of clients to potentially take on that, rate risk per se. But I think this gives buyers further confidence that based on this information, it's even more unlikely that we're going to see a shift from the Bank of Canada, at least upwards, right? So, if you are considering fixed or variable rates are still lower right now in almost all cases. And, the assumption is that, you probably won't see that rate increase. If anything, it may even decrease further in the coming year or two. So it'd be interesting to see how this all, and I mean, again, these numbers come out every month and things shift and things can happen very quickly. And there's always surprises, but based on these numbers, kind of safe to assume, not a crystal ball prediction here, that we won't see the Bank of Canada shift rates, right, at any point in the next few months.
Yeah, there were some kind of further interesting figures with regards to Canada's overall GDP, that 54.5% of Canada's GDP relies on private sector consumption. So with the trade situation with the US and refinance equity takeout markets in BC and Ontario, so equity takeout means people refinancing to tap into the equity in their home. BC and Ontario, Toronto and Vancouver being the 2 primary markets, obviously in Canada, where a lot of equity is kind of generated in most years, are deteriorating from an equity position perspective at renewal. That's likely to weigh negatively on the GDP, that really people aren't able to, either they aren't selling and moving and new money coming, new money coming back into the market for spending, that's going to kind of play into that GDP figure as well, and not like I said, in a negative way. And so with that deterioration of equity at renewal, where we're seeing in 2026 the highest number of renewals in history coming up, because people that got their mortgages in 2021 were all-time lows. They haven't wanted to change their rate since then unless they had to. And so as they're coming up for renewal, it's typically a time where some people pull out some of that equity, pay down debts, et cetera. But in the major markets in Toronto and BC, they're not having that positive equity position because of their values being deteriorated. And so that's going to impact things as they're coming up for renewal. And I think kind of going back to where we were talking about arrears, in unsecured debt arrears, where typically people a lot of times will just, consolidate into their mortgage if that's not available, and that's going to kind of continue rolling out. First time home buyer purchases are going to be, really kind of the bigger figure or bigger driver this year is what they're kind of projecting in this article. And high ratio transfers or switches. So where somebody purchased 5 years ago as a high ratio mortgage coming up for renewal, that they're just going to be renewing dollar for dollar and switching. And like I said, there's a high, record number of these in 2026. So, those are kind of two areas in which they're forecasting that really kind of that, if you're in mortgages, those are the likely kind of clientele that are going to come across. But from that equity position at renewal, it's going to be very interesting to see how that impacts things through 2026 on the arrears to unsecured debt market.
Yeah, and I would say that sticker shock seems to have subsided. So as you mentioned, like a lot of people that were insured, I've been on the phone with CMHC and Sagen more times than I have recently, just trying to get insurance numbers, like for currently insured mortgages that are up for renewal, to transfer them. The conversation seems to be, some of these people are in, under 2% fixed rates, right? So when they're coming, you're kind of expecting some pushback on the rate. Discussing where rates are today, they're almost surprised that they're a bit lower than what they thought they were actually, which is good, because if you remember when rates were in the high fives, the conversations were not so easy to have when people are going from 1.6 to 5.7. That was a pretty big sticker shock. Now going from 2 to 4, still not great.
Insured rates, like really 2 years ago, were up to in the low and mid sixes even. So
pretty wild.
Yeah.
So I think we found like a good, I know we've said this, but like a balanced market for rates as well, where rates are kind of in a place where you can't really be mad, but you're also not thrilled. You're not getting the 2%, but you're also not getting the 6. You're kind of just in that sweet spot right now. And I think between 3.5 and 4.5 to me is kind of like the perfect sweet spot for the market, somewhere in that range, but we're kind of right dead smack in the middle. Balanced market, David. Here we go. Spring's coming.
Well, it's been a pretty negative episode, I'd say. Maybe we should slide into some mood boost the mood.
I got 3.
Hopefully they're good.
And we want to say thank you again to our sponsors before we get into the mood boost. What'd you say?
I said hopefully they're good.
Oh, I thought you said 3 too many, which would have also been accurate.
That would have also been a bit golden.
Thank you to our sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. And thank you all for listening. Every Wednesday, 10 a.m. Here we go. Number 1, how do you get a baby alien to sleep? You rock it. You rock it. Mm-hmm, with Elon talking about putting Optimus robots on Mars, I figured this was a topical, might see some Optimus robots up there getting rocked to sleep, rocketing to get rocked. And number 2, how was the snow globe feeling after the scary story? A little shaken. So that was a mouthful for a short punchline. And number 3, I asked my German friend if he knows the square root of 81. He said 9.
Wow. Okay. I mean, actually, all 3, not bad.
They're getting better, I will say.
Not bad. Yeah. You're scrutinizing them a little more before reading them, which is good.
Yeah, I am. I'm trying to make them a little. Well, I like the original ones. I like ones that I haven't heard before, because there's so many jokes. Everybody's like, yeah, I've heard that. But there you go. Awesome. Well, thank you everyone for being here. Thank you, David. Welcome home. Welcome to this beautiful weather we got here in Canada. And we'll be back next week, 10 a.m. Be sure to follow us on all our socials. Have a great week. We'll see you soon.
Deuces.